Hello, everyone. Welcome to another episode of Snakes and Ladders. As always, I am here with my two partners in crime, Mr. Charlie Lambert and Mr. Jimmy Lee. How are we, boys?
Wonderful. Thank you, Ben.
Is that true, Jimmy?
No, not really. I feel spectacularly awful, is how I would describe it.
Well, you still look okay, a little bit rouge, but, thank you for taking the time to come on our weekly podcast.
No, you're most welcome.
This week, we're talking about something I think's kind of dull. It's bonds. But this week, what's been happening in the markets?
Well, it's been a busy old week in the markets. We finished our last podcast talking about Diageo and their sort of slight share price mishap at the end of last week. However, this week they announced a new CEO, a man who was dubbed Drastic Dave by the UK media. He led the turnaround efforts at Tesco and created a lot of value for shareholders. So how much money do you think shareholders made on the back of him being announced the CEO?
Shareholders made, okay. Ooh.
UK-based business, so I'm trying to sort of stay away from what usually
And it's
happens in the
Diageo.
US
This is a
market.
big thing. So we're talking, 3-4% uplift, something like
Yeah,
that.
so it was up 5% share price increase on the back of the news, which was a £2 billion market cap.
That's a big
off,
vote of
so-
confidence. That's not. I mean,
Yeah.
that's not far off Chipotle, is it? Oh, he may have done a bit better than that, but yeah.
Yeah,
That's half his salary covered then, just from that uplift. That's good.
No, we definitely
apart-
need to do something on remuneration of UK CEOs because he's probably not being paid half of what he would be in the US. So
No, I think there's definitely we're planning on doing a remuneration conversation for this, so we'll touch on that another time. But apart from that, FTSE 100 got within a whisker of 10,000, which would be a record high and a real milestone. And then since then, it has gone straight back down. But
it's been
still
quite
up
fun just to watch our crib sheet for this podcast evolve over the week. So it's like, it's really ripping in our mother.
I know. I've really got to stop. I need to stop writing these at the beginning of the week because, to be honest, I changed them 3 times as I'm going. But anyway,
It's almost like we could use the sort of the guaranteed solidity of something like bonds, I suppose, and that sort of.
Oh, aren't you clever?
Oh,
Ben,
wow.
well done you. Well, look, as we've there is a bit of market chatter, but I think we'll talk about that elsewhere. So maybe we'll crack on and move on.
Before we do, actually, I just wanted to say about Diageo. Does that speak to, Jimmy, you know the UK markets pretty well, right? That sort of uplift from a new CEO coming in, is that relatively new? And does it maybe talk to, I suppose from a media point of view, the sort of the profile of CEOs now in the sort of the media space, and has that become more important?
I think this is probably a slightly unique situation in that they've had a lot of CEO changes since Ivan passed away, and so this is I want to say, is this their 3rd or 4th CEO in a couple of years? So the leadership position there is something that they've been trying to sort out for a while. And then Dave Lewis he would just made so much money for shareholders in Tesco, turning it around post Sir Terry Leahy, that I think everyone just thinks. And what he did at Tesco, I suppose, is kind of what Diageo might look to do. So they've got lots of different
Wasn't
brands.
that? I think, I think strategically it was a clever fit there. And so people would hope that they've got the right man for the job, is what that says, right? Not just, there's a double whammy, like you say, there's like a calming down of leadership, and there's probably a vote of confidence that it's the right sort of fit there.
I mean, it is. I think I read somewhere that it's got over 200 different alcohol brands under its umbrella, which realistically, I think people are basically saying you need to streamline that, sell a few, concentrate on the growth ones. But as he basically did that for Tesco, I think that's partly why people are so delighted with the news. Now, onwards. So the number this week is $130 trillion. That is the total valuation, of the global bond market. I mean, it is proper monopoly money, that kind of thing.
$130 trillion. We need to get the pinky out.
Yeah, and to put that into perspective, the global equity market is valued at $110 trillion. So this is, there's quite a few Nvidias on top of the equity market to get it to the bond market. So I mean, it's just a colossal part of the sort of financial framework of the world.
So I suggest we need to start here, right, with, because a quick "what is a bond" moment.
Yeah, well,
Yes,
I can absolutely use that knowledge. As people might not know, bonds maybe isn't my home turf, so I would like a little bit of a top-down view on what bonds are.
yeah. So, and look, I'm absolutely no financial expert, but my understanding is it is essentially a contract. You are not, unlike when you're buying shares in a company, you're buying equity in the business. A bond is a financial contract whereby an issuer says, I want to borrow some money, you lend it to me. Generally speaking, there's a maturity date at which point the bonds get paid 100p in the pound at par, is the general hope. And in between that period, there is an annual or semi annual interest rate that gets paid to the lender. So it's basically a contract saying, I'm going to borrow some money from you, and it's corporate and government. So the US Treasury market alone is worth $27 trillion.
Trillion, yeah. I mean, that's if
It's
you
to
ever
that.
wonder how governments fund their deficits at the end of the year,
Yeah.
this would be it.
Yeah.
I think the way to sort of simplify it is it's kind of like a loan, except you dictate the terms. So if you and I wanted to go get a loan, we'd have to go and take what the bank would give us. These guys are saying, well, this is what I'm willing to offer to the market. It's a sort of funny position that certain big corporates and governments have, that they're able to do that kind of offer.
And just out of curiosity, because I think that when bonds became real to me is basically how governments fund initiatives, and out of that 130 trillion globally, do you know even generally how much of that is governmental and how much is corporate?
I think it's mostly governments. I'd have to.
Yeah.
We can have a look after this, but I think it is mostly governments.
This
and
is
then you
where
have-
Megan's going to flash up on screen that percentage, so you all now know.
Beautiful.
And I suppose they're known to be almost ironclad, right? You do get the odd default from some government stroke corporates, but ultimately they're a lower rate of return, but they are deemed to be pretty much a sure thing.
Yeah, I think that's right. So UK government bonds are known as gilts because when they used to be issued on paper, they were gilded edged in gold, and
Gold-edged.
they're always seen as being a very safe, reliable.
I
The
think
UK's
we need to
never
be a bit more
defaulted.
nuanced to that. They are not all seen as a sure thing. There
No.
are rating agencies for this, and this is where the whole rating agency thing comes in. So yes, the idea is that the UK or US government should be seen as a totally sure thing. And in fact, if you look at the sort of some of the hype that we've seen this year with Trump tariffs and in the UK with Rachel and how they're going to get spending under control, one of the things you'll see is that the bond market is a way of investors sort of basically saying what you're doing isn't going to work. We're losing faith at your ability to repay this, and we will now only continue to lend you money at higher interest rates. You're going to have to raise them in order to get us interested. That is a vote of a lack of confidence that they will come good, Ben. But yes, historically, particularly those two government ones, I mean, the UK has never defaulted on one of those in the history to date. But that all bonds are not made equal. And you certainly, I mean, obviously, if a corporation is willing to issue a loan note, that corporation is potentially at much higher risk, especially if, it's one thing if you're Apple, but if you're a smaller company, yeah, there may be a risk to that.
Yeah, the yield is a very good indicator of where those bonds sit on the risk spectrum. So if you're Apple, you probably issue stuff at basically whatever the risk-free return rate is of US interest rates, whereas there are some companies out there who have to pay 12.5% a year, either because the balance sheet's stretched or jurisdictionally their assets are in a place that not everyone wants to put money into. There's lots of, Charlie's absolutely right, there's lots of reasons. And you have to remember that the value of bonds it moves inverse to the yield. So as we've seen recently this week, the fluctuation with the value of UK government bonds, the price today, the yield has gone up because the market doesn't like Rachel Reeves's plans to now not do the income tax rise, and so the value of the bonds has come down as the yield's gone up.
And I think it's important to make the distinction here for anybody who's new to this, and we do hope that that's a big part of the audience, right? We want to be a sort of guide into this. That what you're talking about there, Jimmy, the value supposes you're selling it, which you absolutely don't need to do. So it's that there are secondary markets here, and that's what we're talking about, where the fluctuate and what I was talking about.
Yes, I understand. I can't buy it. I can't buy on a primary market. I can't buy a bond.
depends on them, but no, lots of them you can't. You have to have, they've got minimum entry prices, so you have to buy through a mechanism or through your, wealth managers and things give you access to them. So there are mechanisms. But the crucial thing here is that you can, and lots of people will, just buy, a bond, and it's got a 5 or a 10-year maturity date, and they hold it till it matures, and that's it. And all of the rest of this talk about fluctuation is largely irrelevant to them. They are going to still receive the interest payments as long as people don't go bust on the way, and they're going to receive their capital back. However, of course, like anything that you're allowed to trade, people do. They want to chop in and out of them, and at that point, somebody might be willing to buy it off you at a discount or a premium, depending on what they think about their ability to get an equivalent interest rate in the market and the risk that's associated with holding that particular item. So just for anybody coming in here, there are two layers. You don't buy a bond and then they start changing the interest rate on you. That bond in a primary sense is paying to its commitment. It's just what other people would be willing to pay.
Yeah, I suppose if I was to say, so basically anyone buying your bond, if you were selling your bond, anyone wanted to buy your bond, if the yield was lower than a bond that they think they could get in the market, then the value of the bond is lower. So, there's a bond giving 5%, but ultimately people think that in a year there'll be other bonds available for 6%. The actual value of your 5% bond is going to be lower.
Yeah, but also, so it's an example is GlaxoSmithKline, a company which I imagine most people will be familiar with, obviously absolutely massive business. They have some of their bonds trade above par. So so it's 105p, one of their 5.25% paying bonds, which I think matures in 2033. It's 105p. You are essentially paying for 100p's worth of bond, and the reason they're paying more is because it's a great company, but the yield also is 5.25%, which, given where interest rates have gone, that's quite nice for people. And so the trailing yield is now actually closer to 4.9%, but people are still buying it because they want the yield and they think it's a great business.
Sorry, just another one. You talked about Apple as an example, right? So if Apple were to issue bonds and they would issue it at sort of the normal interest rate, why even buy an Apple bond? Why even bother if it's going to be tracking sort of
that's
interest rates?
Actually probably a perfect segue into what's the point in bonds if you're an investor here? What do you use bonds for? And that dovetails with the answer to this. It's about where could you place your money at the minimum possible risk. So back to your earlier statement that these don't tend to default. If we ignore the riskier tranches and we go for AAA rated bonds like a government or an Apple, so there are a few obvious super blue chip companies that you would hope will certainly be able to pay for the 5-10 year annuity. Then what you're effectively saying, and let's use GSK as an example here, you can lock in a just sub 5% return on your money for what is perceived to be almost zero risk. So if you're thinking about, and that's why I think, and it's probably important to sort of, if you think of a spectrum of risk here, you've got cash as the tiniest, smallest risk. It's under the cash under the bed thing. Inflation is the only risk to your cash in theory. Let's assume no one's stealing it. Right through to buying a meme stock or a meme coin at the other end of crypto as the absolute maximum risk. Bonds would traditionally be the first place after cash that you could put your money in.
Well, hang on, wouldn't it be okay, safe as possible? Because ultimately, if you're putting in a high interest savings account, those interest rates will fluctuate. Oh,
but that's still cash, right? You're keeping it in digital cash with the bank. So if you're moving then into a bond, and yes, as you say, there are decent long-term interest rates offered by a bank, and you may well consider that as an alternative to bonds. But especially over the 10 years, it's unlikely you'll be able to know you can have an interest rate for 10
Understood.
years. So it's a defensive position, and for me, I having grown up, I suppose, like all of us really, but with Warren Buffett as the hero of the generation, then you go, all he says is go and read Benjamin Graham's book, The Intelligent Investor. How does he apply things? The point here is that any investment portfolio in that, if you were to follow his book as the Bible, should absolutely have a bond portion to defend against the potential fluctuations in the equities market. And how you would balance those depends on your risk appetite and how long you think you're going to be in the market. So the classic one of, well, the stock market might dive, but I'm in it for a 20-year period. So frankly, that won't matter as much. So I can afford to be a bit more equity focused. But it should also be judged based on the relative value at the time. And this is where I'm kind of curious to get your thoughts as well, both of you, on. We've hinted at it in the past couple of weeks. I would suggest Ben and I have, when we were talking about this topic this week, both been pretty transparent that, and for me, I'm big on theory and absolutely shit on actioning this. I haven't really done a huge amount so I know what I should be doing to balance the portfolio. Practice done almost nothing to do so, and but given that bond rates, the government stuff is looking like pretty reasonable returns, that because the economies haven't been performing that well, so they're having to offer pretty reasonable rates, and that maybe the AI bubble is there, this probably potentially is a good time to be giving this some real thought and focus. I'd love your opinions too, guys.
Yeah, and also the other thing I'd say is there are certain UK government bonds where there's actually tax advantages. So I can't remember exactly.
Winner.
Yeah, who doesn't like a tax advantage? But yeah, what sort of happened in 2023, I think, was you're absolutely right. You normally have bonds in your portfolio to help mitigate the volatility of equities, and normally the bonds either go up in value as equities go down, or at least they stay the same, so you don't lose any money. It's very rare that they both go down. However, I want to say in 2022, I think it was, bonds also went down because interest rates came up so quickly that a company yielding 5%, well, you could get 5%, in a high yield savings account. So what was the point? Whereas now, as interest rates have come down, people are a lot more interested in, and it's locking in a return. I mean, if you are looking to make 5 to 6% a year, and you don't want to take risk, well, then you don't need to be in the equity markets. You can make 5 to 6% a year by owning certain bonds.
So if we turn that into a couple of predictions from people just slightly better educated than us, i.e. the people at Vanguard, let's have a look at what their thoughts over the next 10 years on UK gilts. So we're talking very specifically the UK gilt part as opposed to the US equities or anything else, we're excluding that, is annualized returns of about 5 to 6% for UK investors, it's a projection. And equities, 5.7 to 7.7% per annum over the next decade. So you can see they're obviously fairly close. And therefore, if you were to follow this logic through about having less risk for a very similar return, that makes bonds over the next 10 years look like quite a sensible part of anybody's portfolio, because you'll say, okay, yeah, equities might outperform them, fair, but we're all very conscious that equities hold far more risk and the fluctuation on the way. So locking that in is a sensible way. And for anybody looking who I don't know if anybody's seen the tome that is Benjamin Graham's book. It's massive. It took me a long time to get through. Just to give some sort of semblance of what that balance might look like, because I've said, it should be part of your portfolio. Well, if it's the gold standard, according to Warren Buffett's guidance, would be that the standard place to start is 50-50, but that you would never want to go too heavy. So you'd never want to be 80-20 or something, let alone 100-0. That would be too much of a stretch. So the balance either side of 10 or 15% one way or the other would be that kind of the bedrock of a defensive investor on how. So if you're thinking about how do I put this portfolio together and what sort of ratios, that's a decent place to start. Then if you're thinking to yourself back to what individual considerations would make me go one way or the other, speaking amongst us, there is obviously more appetite for risk because we have longer for the equities markets to recover if they have a dip. So we're much more likely to go equities stronger rather than bonds. And for the obvious reasons, the inverse could be true. So if you're looking at this as an older investor, you think, okay, well, if I need to draw that money out in 5 years and it happens to coincide with a downturn in the equities market, that would be rubbish for me. Whereas the bond I could take out in 5 years' time, as Jimmy, you were alluding to earlier, one would hope it's worth similar kind of money, if not more. So there's a much more protection.
And I think it's important to explain why equities are more risky inherently than bonds. And it is, in short, because in the capital structure, a bond sits higher than owning equity in the business. So in the event there is a default, the bondholders, and there's different levels of seniority to bondholders. So some bonds will be secured against a particular asset or business division or not, and then other bonds, they're not secured, and that will all have an impact on the yield of the bonds. So a secured bond that sits at the top of the seniority cap structure will have the lowest yield. Then you can have some bonds which are much lower down, which basically means in the event of a bankruptcy or liquidation, you're less and less likely to recoup your 100p in the pound. And we've worked on I've been involved in a couple of financial restructurings where the equity holders have ended up owning 5% of the business and the bondholders have ended up owning 95% of the business because they've had to do a complete balance sheet restructure, which, obviously is not nice for anyone.
Wow.
But there's a very good book which I would highly recommend called The Caesar's Palace Coup, and it's by Sujit Indap and Max Frooms, and it's this really swashbuckling tale of what the authors call creditor on creditor violence, which is, so Caesar's Palace was bought by Apollo and TPG in a leveraged buyout just before the 2008 financial crisis, and basically Nevada was particularly badly hit, so Vegas was very badly hit. The business was going to go under, and the whole book is about all these different creditors at a different bit of seniority, all the bondholders basically fighting each other. I mean, the legal cases, the lawsuits, it's an unbelievable
Who won
story.
there? The lawyers.
Yeah, undoubtedly the lawyers made but Elliott, the investment fund, made $1 billion just on the back of owning. Yeah, but I would highly recommend read the book or listen to the audiobook. It's fascinating in the nuances of some of these bonds and how they all work when push comes to shove.
Well, I think I still got a bit of a way to go to fully understand the mechanics of this, but I'd say the principles are pretty simple. So thank you.
Here's the real question. Oh, so go on, go, Jimmy.
No, I was going to say we normally talk about how investors can gain exposure, which I know you've touched on a bit there, Charlie. But on Hargreaves Lansdown, AJ Bell, you should be able to buy them directly. There's also lots of bond funds which you can look at, which are slightly more diversified because they're pooling lots of bonds together. So it should de-risk it.
Sorry, question. When you say buy directly on Hargreaves Lansdown, explain that to me a little bit. As in, you can trade the bond from somebody, the actual.
You can buy UK government bonds and other bonds on, but most bonds don't trade on the London Stock Exchange. That's not where you buy a bond. Most of them are over the counter. But Hargreaves Lansdown, AJ Bell, all those guys have facilities on their platforms for you to invest, and you can buy investment trusts with bonds or funds with bonds.
They're a liquidity provider in between, right? So market makers that enable it.
Yeah.
So you can. So my question for Ben now is he remotely convinced to put some part of his portfolio into bonds?
No. No.
So we failed terribly, Jimmy.
No. Look, okay. I think I obviously understand why, but I'm quite happy at the moment with having near half of my wealth in a high interest savings account. And the other half in equities, I would say. It's actually pretty close. I'd probably say 60% is in equities.
So you're saying you're using the bank account as the bonds equivalent?
Yes. Yeah. I think the interest I get on a bank account, I would, and you know what? I probably just need to have a look more. But with the money that I have in that account, would a 1% or, even 2%, would that make such a difference?
Compound.
Sorry?
Compound.
Would that make such a difference on the money that I have based on the high interest savings account I have?
Oh, I feel a spreadsheet coming on.
No, not particularly. I think I quite like having it in my account, and I quite like the liquidity of my equities in my other accounts. So, but all good learning, and maybe one day I'll mature and get myself a bond that I'll be frustrated with. That I can't fucking sell it, but whatever. And speaking about buying bonds, we've actually got a new segment we're introducing this week.
We need a theme tune.
Yeah, called Roll the Dice. So in Snakes and Ladders, obviously rolling the dice is important. We're going to roll the dice on what equities or this week bonds we should buy. So how it works is we are going to choose 4 equities or 4 bonds every week. We're going to roll the dice. This dice specifically having 1 to 4. And whatever comes up, we are going to put money into, and we're going to put that on a public portfolio that you guys can track to see how we do. We want to show you how easy it is to buy these things and how we can track it, and also hopefully how successful it can be. So this is our inaugural dice roll. Charlie, do you want to take the honors from here, buddy?
Yeah, okay. So, as Ben said, we thought, generally speaking, this is probably an equities pick. We want to make it sort of thematic and topical, but we do want to show the power of this stuff. So I'm going to walk you through. Firstly, I suggest, what are the potential picks this week? So we're keeping it UK focused, as you know. We're trying to lead the charge on this. And these are a selection of gilt ETFs. So it might be useful for Jimmy to supplement this. But the point here is that this is therefore a selection of bonds as opposed to buying a specific bond that have been packaged together for their relative merits. And you can see there's quite a big fluctuation in prices here. That is the price per share of these ETFs. So that will come down to the number of shares available and the underlying bond ownership. And but these are designed to be to consciously been chosen as being a kind of solid base. If you were considering that first sort of bond piece to put into your portfolio, please always do your own research. It cannot be more clear that we are not here to give financial advice, but I would suggest that the leading wisdom is that bonds are a good part of a portfolio, and here are 4 from big well-established platforms with teams and teams of people doing the research to keep them up to date and a sound investment. So they would not be an unreasonable place to start. The important part is, which one are we going to be buying this week? So number 1, iShares by BlackRock's core UK gilts. Or are we going to be going for iShares from BlackRock, core UK gilts, and some corporate bonds, spicing it up with a few corporate bond issues in there as well? Or we're going to be going for the Vanguard UK gilts or Invesco's UK gilts. And the way we're going to find out is with this totally stunning dice roll of it. I mean, I know you're all absolutely thrilled to see the quality of production here. Google Dice Roller coming to the rescue. But this is where we really do need some dramatic music. Are we ready for the roll? Number 4. Okay, so we are swapping back over here. Going to be buying Invesco UK gilts. Right. What does this really come down to for everybody? Let me share with you how you can follow this journey. So share this tab. We will be posting below the podcast for you today a link to our Snowball Analytics dashboard. You can see on here that I've actually put, here's the one single share price of all 4 of those. What we will actually do is the portfolio that we are buying, we're going to be putting £20 every week into whichever one of these that whichever one has spun to win. So this week, as we just said, the I've forgotten the number already. The Invesco gilts piece, and you will be able to see how that performs. Whenever you like. This is always live. It's using live tracking data, but we will obviously add into it week after week after week all the different equities and pieces like that, and you can see what it's like to watch a portfolio grow and evolve, and hopefully with a bit of spin in there for fun. Let's just be really clear. Please, for goodness sake, do not make your investment decisions using a dice roll. But seeing as this is just for the sake of an audience, we thought that'd be a bit of fun, and you can track how the portfolio does. So that link will be there.
Am I right in thinking, Charlie, that you've personally decided to put £1,000 in every week for this?
Yeah, and I will absolutely. I'll be matching it and adding 10x. Yeah, so yeah. But look, come and join us on the journey. We really want people to start to see what it's like to actually be investing in these spaces. So this is, and by the way, Yahoo Finance produces a really brilliant free personal portfolio tracker. So does Snowball Analytics. If they want to sponsor the podcast, please get in touch. They have some paid tools that do other things that are really, really nice. But this account that you'll be watching, we have created completely for free. It allows you to set up a portfolio, and it really does have phenomenal number of integrations. I mean, it can track what you buy from all over the world, because not all platforms can. So I would also, if somebody's thinking about how do I centrally see my net worth and I've bought things in different places, these are the sorts of tools that are really useful. So nice to be introduced you to one of those.
Meme coins? Does it do meme coins?
I haven't looked, strangely.
For God's sake.
Useless end of the market. This is for rock solid investment type analysis. And you will also be able to see, you know, gains and losers. One of the really interesting tools in Snowball is one of the things I alluded to talking about bonds is how much of your portfolio to balance your portfolio, how much might you have in any given fund or across the spread. And they actually have a tool called Rebalance Your Portfolio. So it will have a look at the current risk return rates and help you, or if you've had a particular explosion in a stock, say Palantir, how you might redistribute that win sensibly so that you're keeping your portfolio balanced, which I do honestly think is a really clever, quite powerful tool to have in the toolkit. So check it out. Come join us. And our first winner is Invesco UK Gilts 1 to 5 years. So we will make that purchase. We will show you what the purchase cost us, including fees, on this dashboard, and you can follow along.
Thank you very much. All right. Fun little thing to do at the end of our podcasts. Hopefully there'll be wealth in it for us all. Thank you very much, lads. Very interesting. Even if I'm not going to jump straight into the bond market, I now feel well equipped to do so when that does happen. So thank you very much. Thank you to everyone for watching and listening. Please feel free to share and follow.
Like and comment and subscribe.
If you like this, send it some friends. You know, why not? Let's get everyone involved. Lots of love, everyone.
Bye.
Bye.